Hi, this is Sean, Director of SBL Financial, and following our theme of podcasts, videos and audio media, we have another Finance from the Coalface production, of which we've talked to the lovely people at VAS about everything specialist in valuations, whether residential or commercial, covering everything you want to know about valuations, various scenarios, and why things are done the way they're done. So grab a cup of tea, find a comfortable chair, and listen to what myself, Louise and Andrew have to say over the next 30 minutes on this audio podcast. Hi, I'm Sean from SBL Financial, and today I'm doing a podcast with the lovely people at VAS. And I have with me today Louise Chapman, who's the Commercial Director, and Andrew Murdoch, who's the Valuation Panel Director. So good afternoon, everybody. Thank you very much giving me some of your time. So first off, the first thing I just want to ask is, to explain to everyone, can you tell me a bit about VAS, please?
So VAS is a valuation panel manager. We work with a lot of the country's challenger banks and smaller lenders as well, smaller bridging lenders. So we are quite experienced in the specialist space. We were born from an audit business 10 years ago, and then out of the back of the audit business, we then opened a second part of the group, which is the panel business. So our main USPs are risk mitigation to the lender, and also our team that we've got up here in the northeast office of Middlesbrough to be able to provide what we believe to be service excellence to the lenders and our broker partners.
Oh, fantastic. So I've got some prepared questions. So some of your partners are probably known banks and providers like Together, Shawbrook. So obviously, you know, for you to be their nominated go-to firm, they must have a degree of confidence in the service you provide.
Yeah, I would say so, Sean.
So could you explain the difference first off between the 90-day and 180-day valuation that lenders use?
Yeah, so effectively, all valuations start with market value, which is the there's obviously a strict definition, RICS definition of what the market value is. Lenders will then, in an attempt to de-risk their loan or reduce their exposure, they will then ask valuers for a number of different special assumptions depending on their lending criteria.
Yes.
So that they will then look to add a restricted sale time frame to the market value. So market value could be $1 million. They will then say, okay, what if you had to dispose of that asset within 180 days? What would it be worth? And then similarly with a 90-day. So if you have 3 months to sell that. Now, a number of different lenders approach it in different ways. Some will ask for a sale to be exchanged within those time frames. Some will ask for a sale to be completed within those time frames. So it very much depends on the lender's criteria and what their instruction letter says to the valuers. But effectively, it's a way of de-risking it, and it almost looks at effectively a worst case scenario. So your 90 days typically, if you had to, as a lender, if you had to appoint a receiver and dispose of it, say via an auction, what would you get on that basis? So it literally is as simple as that. It's a way of sort of bringing down the values in a staged approach, and then, as I say, depending on their lending criteria, they will choose which value they choose to lend against.
Oh, thank you very much. One of the questions that we get asked quite a lot by would-be new investors who are looking to go on their HMO journey, as an example, is they ask for a commercial valuation against bricks and mortar. And obviously they go on courses and hear that commercial valuations give a higher valuation than bricks and mortar. But obviously we try and manage our expectations that, yes, you may get a commercial valuation, it may be slightly higher. Most of the lenders will also defer back to its bricks and mortar value.
So I think there's probably a couple of things worth picking up there. I take it by commercial valuation, you almost mean an investment valuation.
Yes, most
so
definitely.
A value as an investment.
Yes.
And then by bricks and mortar, I assume you mean to the vacant possession.
Yes.
Yeah, so the RICS doesn't like the term bricks and mortar. So you might see in a lot of lenders' instruction letters it's market value with the assumption of vacant possession. So that's effectively the old bricks and mortar definition. So essentially, why would an investment value be higher than a vacant possession value? Well, in short, because it would be income producing at that point. So if it's valued as an investment, the market value will be subject to any tenancies or income that property is producing. So a third party could come along and buy that with the benefit of that income already been there, already been received. If a property is vacant, there's obviously risk associated with that. You might potentially have holding costs. You might have letting costs.
Mm-hmm.
You've also got a lack of income that's coming in. So a third party would have to go and generate that income by letting it, either doing any works or refurbishing the property in order to get it let. And there's also the risk attached that you may not get it let as quickly as you might want to. So naturally, the valuation will be lower on a vacant basis. If a property is a natural investment type property, a vacant one is going to be worth less than a fully let one.
And would you say it's going to be a lot harder to get this investment-led valuation for someone starting out and not got a proven track record on that property? So it's all very well saying it's going to be investor-led and that, but if they haven't got quantifiable data or historic accounts to demonstrate it's produced that, they're going to be on a bit of an uphill struggle?
Well, I think that would very much be an underwriting decision for the lender. I think you might get sick of me keep referring back to lenders' sort of credit risk policies or lending criteria, but that is what a lot of it sort of comes down to. It's the lender's risk appetite. So, like you say, for a first-time investor, they may have no track record. How is a lender going to reflect that risk? Because that is a risk to them that, the applicant may not be able to perform. They may well do, and great, everyone's happy, but they may not. So lenders will naturally reflect that risk in any lending decision they make.
Yeah. And then, again, in a similar vein, I think there's sometimes a big difference between client expectation of valuation to the reality of a valuation and a valuation based on for a mortgage lender. So, we do sometimes see that where expectation doesn't meet reality. There's a difference in that. So moving on. So when we instruct you as a company, can you sort of explain to the clients why perhaps there's a difference in lead-in times from various firms and why there can be a difference in price?
Do you want me to say that, Louise, or do you want to?
Either or.
Well, in terms of lead-in times, I guess it would depend on what the asset is. If it's a straightforward residential asset, might be a straightforward buy-to-let, then obviously that can be undertaken by a residential firm, and there's many sort of volume residential valuation providers out there. They tend to use short-form reports. They can turn them around a lot quicker. They have shorter SLAs. The other end of the spectrum, if it's a large complex property, it might be specialist in nature, it could be a large development. Naturally you'd want the right firm valuing that asset. Say if it's specialist, there might be a lot more due diligence required. So it very much depends on the nature of the asset, so what it is, where it is, and the sort of value attached to it. And the level of due diligence that's required to produce that valuation.
And this again is another a myth where does a broker have any influence on a valuation? And everything is dictated by the lender as their instruction to you as the panel who goes out to the valuers.
Yeah, so you are right, Sean. So we work on behalf of the lenders. So they dictate what we can and can't do. They dictate their instruction, how they wish certain properties to be valued, at what level we can communicate with brokers, whether it's not at all or they allow broker-led instructions, but they won't allow brokers to, say, maybe request a valuation firm or raise the PDQ, where other lenders might say, we don't mind, or we're happy for the brokers to do that. So everything we do as a panel is completely dictated by the lenders. Our broker partners are really, really important, and I think we work with over 4,000 brokers now. And
oh, really? That many? That's a lot.
Yeah, over 50% of our business is broker led. So we're hoping that as the years go on, that our broker partners know the lenders who they're requesting a quote on behalf of, and they'll know that particular lender's requirements in regards to what we can and can't do. So, you know, what does that lender allow that broker to do on behalf of them?
Yeah, oh, brilliant. That's a brilliant answer. And I think this leads on to sometimes we've had a valuation done and that valuation hasn't met, shall we say, as the previous comment, the client's expectations. So he said, Sean, I want to get another valuer to do that. However, in some circumstances we can, and in others we can't because it's down to PI insurance. And are you able to sort of elaborate a bit more on that?
Yeah, so I mean, firstly, touching on the differences between, shall we say, an applicant's expectations and the values reported by a valuer, it's important to remember that the valuer is, what's the right word, driven by the lender's requirements.
Yes.
So everything the lender requires is in their instruction letter. They may have supplemental sort of valuer guidance notes that sit alongside that. So the valuer is very much valuing in accordance with the lender's instructions. So an applicant may be acquiring a property for a certain purpose. It may have a certain value to them. However, when valued in accordance with the lender's instructions, including any assumptions or special assumptions, so I think quite often the market value can be broadly similar, but then you come down to discrepancies between the vacant possession figure, the 90-day, the 180 figure. And a lot of time applicants don't understand why those figures are being used by lenders and why there's such a discrepancy between market value and the other bases that are being used. I think some of it comes down to, I guess, expectations. Look, if properties rise, then everybody's keen to highlight how much the price has risen. In the last 12-18 months, we have seen a fallback in values where they have come in slightly. Naturally, applicants are probably not so keen to acknowledge when values might not be or might be have reduced or remained static. And I think it's part of, an important part of where brokers can really help is almost understand where this value is coming from.
Yeah.
How educated is the applicant? There are some very...
And we try and do as much due diligence as possible, but unfortunately you do get an applicant who thinks he's perhaps got a brighter, shinier diamond than perhaps he actually has, and feels, he's done certain things to this property to go above and beyond what perhaps the market dictates as a general rule of thumb.
Hi, John. Can I just jump in there just regarding that particular question? So I think for brokers, the key is knowing the lender's instruction. And if you've got a client with a specific property type, knowing or preempting how the lender's going to ask that valuer to value it. Yeah. And that is something that we try and educate brokers on all the time. An example, and one thing that I see quite regularly, is new build properties. So your new build property could be worth £200,000, and rightly so, it might be worth £200,000. But if the lender's asking the value to value it, excluding new build premium, the report is going to come in lower than the £200,000.
And I think that's a really important, valid comment, because we do see a degree of clients come to us for new build investor-led developments, and they are seeing a down valuation typically against what they agreed for when they exchanged 2 years ago before it was built, and then it's built and ready, having the valuation done. But quite rightly, if you're saying they're saying value it without the new build premium, that's where the discrepancy is going to come from.
Exactly. So the property could be worth 200,000, like I've said, And I think, but when the applicant sees the report and sees a lower figure, immediately it's a cause for concern. But that's how the lenders ask the valuer to value that particular property in line with their instructions.
Yeah, no,
Sorry, Andrew.
very good. And then recently, due to the time it takes to get things through at the moment, and I don't mean on a valuation side, I mean with lenders from offer to completions, we're seeing more, and I've contacted you in the last week for this actually, we've seen more where within a couple of days the valuation's expired and you're like, oh no, the valuation's expired. And we're having to ask you to go back to the valuer for a rely on. And if you'd like to explain what the rely on is, please.
Yeah, so I think it's important to note that valuation reports don't expire as such. So a valuation is only valid on the date it's done. So
Right.
The valuation date. Property's worth, if there's a valuation date today and it's worth £1 million, all the valuer is saying is, as at today's date, that is worth £1 million. They're not commenting or committing on what may happen going forward. So
a bit like an MOT. It's valid on the day it's done.
Exactly. And so that's quite often what valuers will say. I valued it on that day, at that value, that's what it is. Fast forward to an application's dragged, taken a bit longer than expected. Take Together, for example, they require a rely on after 3 months. So that is simply the lender saying, saying to the valuer, in your opinion, are the values still the same that they were at the time that you did the original valuation? Now, they may be, they may not. The valuer might not know without checking or doing some further due diligence. So that it literally is as simple as that. That's all it is. So it's down to each individual lender's, again, own sort of credit risk policy as to how long they can rely on a valuation for themselves. So some is 3 months, some is 6 months. There's a variety in there. So depending on who the lender is will dictate whether they need a rely upon letter or whether they're happy to proceed with the original, based on the original valuation report. But all it is a lender saying, do you still think these values are the same at the date you did the valuation?
Okay, thank you. And then obviously, depending on what type of application that we put in some cases we're asked for a long form against a short form. And obviously there's cost implications over the two different forms. So, by definition, a short form is a bit more of a brief report and a long form is obviously a lot more in detail report. And as such, the price correlates with each that. Would you like to sort of elaborate a bit more on that, please?
Yeah, so effectively, a short form report is generally only for vanilla residential properties, so single dwellings, single houses, single flats. There's a number of sort of predefined boxes for the valuer to complete, and it's a relatively simple and straightforward valuation to do. A long form report is for pretty much all commercial properties. Again, coming back to lenders' criteria, they may have a maximum value threshold where they will only use short form reports up to a certain value. Over and above that value, they want a full long form report because either the property is more substantial, higher value, they want additional commentary and comfort in there. And with commercial valuations, there's a lot more due diligence that has to go into preparing a valuation. They have to meet the minimum RICS Red Book requirements of what goes into a report and what it contains. They've also got to meet the lender's requirements. They've got to go into quite a lot more depth around the methodology, the comparables they use, how they've arrived at the valuation, and loads more statutory inquiries that are not included in a short form. So that is the reason for the differential in price effect. So there's a lot more work that goes into a long form report.
And moving on, is there such thing as a formula for valuing an MUFB where you have 4 flats in a building against obviously 4 flats in a building on a separate title and being an individual entity?
A set formula, no, but again, it would come down to what assumptions the lender is happy with the valuer making. So if you have got 4 flats, say, on a single title, that's only going to appeal to an investor who would either look to acquire the property gain the income from it, or they may well look to split the titles themselves, set up a management company, and sell individually on long leasehold titles. Quite often you may see that the value of the individual units may total more than the single title or a bulk sale of the lot, simply because you're only going to appeal to investors. So there's no set formula, but you would probably possibly expect a slight discount as a
MUFB
4 units under a single title rather than separate titles.
That's lovely. And why would a valuer then only give a cash value on a property?
So again, that comes back to the lender's requirements. So if you think of high street lending, say for example, a regulated mortgage,
yes,
a valuer would go out, and the high street lenders have pretty strict criteria in terms of what they will or won't accept as property types, or so some won't lend flats for hot food takeaways, for example. So in those instances, they would say to a valuer, if it's X, Y, or Z, report 0. When it goes through their underwriting and processing teams, they will just reject that application. Where in the challenger bank space and the specialist lender space, by their very nature, because of what they do, they will take a view on what the high street won't. So quite often a lot of lenders will say, if the property isn't suitable for normal high street mortgage purposes, i.e. if Barclays or Nationwide or Halifax wouldn't lend on it, give us a cash value, i.e. what an investor would pay for it without needing access to funds. Now, it does bring its own problems in, because cash values are very subjective.
Yes.
And they will naturally be lower than the market value, because you've instantly got a limited pool of purchasers, potentially with cash in the bank ready to buy this, or access to a specialist lender who will charge higher rates of interest. So cash values can be significantly lower, partly because the pool of potential purchasers has shrunk immediately with lack of finance, and partly because it's incredibly subjective.
Super. And I want getting to the end now. You'll be pleased. You'll be pleased to hear. I've got to pause it a second. Hopefully, I won't lose you. Hopefully, you're still there. Tom, I'm given a time limit, and we're going to run out in 30 seconds. So we're just going to finish mid recording on the last couple of questions. So I've just paused it.
Thank you, Tom,
Okay. And if I continue that recording, it came up that I only had a few minutes left. Can you do anything with that?
Oh, what, the recording?
Yeah.
We just smush them together.
Oh, okay. All right. Do you want to just sit there, because you might get to a cut-off point and we have to...
All good.
Because it's all finished. And Sean... right. Let's get to the last couple of bits. We're seeing valuers, especially on properties where clients want to refurbish and add value, or probate where they've been empty, asking for damp and timber reports. And we're seeing that more frequently now. What would you think is a trigger, and what clients need to think of when they're looking at the property? Because like everyone, they moan and groan because they think, oh, I'll get the valuation done. Valuation's done, boom, off I go. And then all of a sudden, valuation's done. They say, oh, we think it needs a damp and timber report. Of course, the client thinks, oh, it's just a little bit of on the wall. And then you have to obviously not only find a specialist firm, but obviously that adds a time aspect to obviously the process.
Yeah, so the trigger for a valuer asking for a timber and damp report would be visible signs that there may be issues with the timbers or damp issues.
Yeah.
You talk about, oh, there's only a little spot on the wall. Well, the valuer more than likely is going to be unable to tell what has caused that. So he will report a market value on the assumption that, generally on the assumption that the property is fine in reasonable repair. But if it's not, then, the lender's going to come looking for him effectively. So it's not that, look, it's not that they've been overcautious. It's if there's something that they've genuinely noted on inspection that requires further investigation, they've got to make the lender.
I mean, ultimately, they're you're paying them to do a report, and that report is to protect you, whether that's from a price point of view or the condition of the property.
Well, it's to protect the lender, effectively.
And obviously the lender as well.
In the non-regulated sphere, these are all for the benefit of the lender. It's only in the regulated sphere where you get a sort of home report that it's duly addressed to the applicant and the lender. But no, look, lenders want to make sure that either they're not lending on problem properties, that suddenly the borrower is going to have to, major structural issues, or the borrower is going to have to go and raise thousands of pounds for some repairs that they weren't envisaging, which is going to impact on serviceability of the loan, or that they may well still be happy to proceed, but reducing the loan amount. So it's, valuers are there on behalf of, behalf of the lender, but also to partly advise the applicant, because I think if I was going to acquire a property that had major timber and damp issues, I'd want to know about it.
Oh, definitely.
So, they're not. I think there's a bit of sort of unfair criticism that a lot of people think valuers have been overly cautious in recommending this, but genuinely, if you're on site and you spot some rotten timber work, you don't know how far back that goes.
No.
What's the depth of the issue? Is it just one floorboard?
The applicant may have only been there one or two times and had a customary glance at, oh yeah, that's the bedroom, and maybe not really even properly noticed the extent or bubbling, plaster.
Yeah. And look, condition is something that is very much expected of the valuers to comment on.
Yeah.
So, if they missed something or didn't highlight it, and the lender faced a shortfall, then let's be honest, they'd be looking to take action against the valuer for professional negligence.
Yeah. Oh, well, that's brilliant. So hopefully I've sort of given some in-depth sort of questions to you today for our clients and people who have these sort of questions. So a nice fluffy one to finish. I think this one's for you, Louise. Why do you think you're one of the biggest valuer panel firms for residential and commercial, and that you've won awards?
I thought about this question a bit, Sean, because before we came on, and I think we have a lot to offer for all our clients, lenders and brokers. For lenders, we mitigate the risk. We make sure we're getting the right valuer with the right expertise, local advice, and providing that security and safety to the lender. We provide service excellence. We have a team of 51. We hit SLAs, we work into very strict internal KPIs, and we're happy to share what we do as well. So, especially for our broker partners and our lenders, we know that sometimes the valuation part of the lending journey can be somewhat stressful, possibly at times, making sure that you get the right firm, the inspection booked in, and the report returned within the SLA, and then the report being all packaged up ready to be able for the lender to make a decision without a lot of to and fro-in and questions going backwards and forwards. We have an amazing panel. We have over 200 valuation firms from the global and national practices to really good local and regional firms, and then we've got your high resi volume valuers as well. So we feel that we've got it all covered.
Yeah.
In all areas. So, and we're doing a good job, and we're mitigating the risk. So I'd like to think when you put all that together, I think that's why I feel we are one of the best within the country.
And just for full disclosure, we're a regular customer as well of Fast Panel.
Why do you like using us, Sean?
It is so we get a good service and good turnaround. You're not the only. There are a few others who we sometimes may use, but Vast Panel is our, shall we say, majority one. We do a lot. We're a packager and underwriter for Together Bank, and as such, physical valuations are done typically as their preferred partner by VAS. So obviously we use VAS a lot. Castle Trust, companies like that, you are their go-to panel for valuation as well. Obviously they've partnered with someone that gives them confidence in their specialist lending and bridging market. So as we have sort of grown and expanded, and we now 3 offices, as such, we are a specialist broker. So, you're not getting rid of us anytime soon.
Oh, glad to hear it, Sean.
But I just wanted to say thank you ever so much for your time. Thank you ever so much for your time today, and hopefully this will be really insightful for our clients who come to us, and sort of rather than they then have done things or come with a preconception, by sending this on the groups and they can watch it, it give them an understanding in the valuation part of the process that's sometimes overlooked.